Hello, and welcome back to VitalCash. It's official. China's unstoppable growth has come to an end. Despite being the world's second-largest economy, their financial system is falling apart. Today, we're diving into the looming economic crisis that China faces, the factors contributing to it, and the potential global impact. But before we start, if you appreciate the research that goes into making a video like this, all I ask is that you hit the like button and subscribe. It helps out the channel tremendously. Now let's get into it. Let's delve deeper into the background of China's economic journey. For the past 30 years, China has been at the forefront of global production, international investment, and rapid productivity. This remarkable trajectory began in 1979 when China established diplomatic relations with the United States. This pivotal move opened the floodgates for international money to pour in, with countries worldwide investing in Chinese infrastructure and taking advantage of the low-cost labor market. By 2001, China's impressive growth led to its membership in the World Trade Organization, further solidifying ties with the United States. However, this growth came with consequences. The demand for low-cost Chinese goods skyrocketed, leading to the outsourcing of more and more products and corporations relocating millions of jobs overseas for higher profits. While this benefited China immensely, lifting over 400 million people out of poverty and making their economy 11 times larger than it was in 2001, it also raised concerns about China's increasing power and influence over global businesses. Members of the World Trade Organization accused China of providing illegal state subsidies to businesses, discriminating against companies not buying from Chinese manufacturers, and controlling supply chains through taxing raw materials. There were also allegations of deliberate currency devaluation, creating a facade of economic growth that might be unsustainable. As we fast forward to today, these issues have contributed to the current economic challenges that China is facing. China's impressive economic growth story was, in part, fueled by its role as the world's economic miracle. However, this growth, while significant, concealed underlying problems. As China became more powerful, it gained leverage over businesses and became more challenging to collaborate with. Now, the cracks in the economic facade are becoming more evident as we examine the challenges faced by the Chinese economy. Now let's delve deeper into the challenges that China is facing. First and foremost, we are confronted with a concerning situation of youth unemployment, a problem so severe that the Chinese government has ceased to release official data on it. The expansion of higher education in 1998 resulted in an excess of graduates, creating an imbalance between the supply of the workforce and available job opportunities. Consequently, many young Chinese individuals find themselves unemployed, with some resorting to unconventional solutions, such as participating in lotteries to achieve financial freedom. Secondly, China is grappling with a real estate crisis of considerable proportions. Over the past decade, a massive real estate bubble has emerged due to heavy investments by the population in property. However, with economic growth slowing down, builders are struggling to raise capital, leading to defaults and protests. Even major real estate developers like Evergrande and Country Garden are on the verge of default, with billions of dollars at stake. Thirdly, the ripple effect from the real estate crisis is giving rise to deflation. China's reduction of interest rates to stimulate growth may not be sufficient as consumers become reluctant to spend, further fueling the vicious cycle. With the real estate sector constituting 30% of China's GDP, the impact is widespread. Finally, the shadow banking crisis adds a significant element of risk. Shadow banks, operating in unregulated sectors, such as hedge funds and private equity, are now under scrutiny after missing payments to 3 publicly traded companies. This situation could trigger a chain of events, with the risk of contagion spreading throughout the entire financial market. Let's delve deeper into the real estate crisis that China is currently grappling with. Firstly, China has experienced a massive real estate bubble over the past decade. Chinese citizens heavily invested in property as a financial safeguard, leading to double-digit increases in home prices year after year. However, with economic growth slowing down, builders are facing challenges in raising capital, resulting in the collapse of ongoing real estate projects. The situation has become so critical that even major real estate developers, such as Evergrande, are on the brink of default, with hundreds of billions of dollars at stake. The phenomenon is further complicated by the fact that Chinese citizens, witnessing the rapid growth of property values, were willing to pre-purchase units under construction. making payments on properties that didn't yet exist. The soaring demand led to the allocation of homes through lottery systems in some cities, with odds so low that they reached 1 in 60. This rush into real estate investments has tied over 70% of the country's wealth to the real estate sector, more than twice as high as observed in the United States. The rapid price growth has prompted a credit frenzy, with buyers paying up to 23 times their annual income for a home. Some even borrowed money from friends and family just to claim ownership of a property. Beyond the financial consequences, the real estate crisis has also sparked an increase in protests. In a 4-week period following Evergrande's default, more than 320 projects in about 100 cities faced protests, roiling markets and forcing authorities to intervene with banks and developers to diffuse tensions. Now let's further explore the economic fall and the specter of deflation looming over China. To begin with, the economic trajectory that once seemed unstoppable for China has hit a significant roadblock. Despite being the world's second-largest economy, signs of financial distress are becoming increasingly evident. One of the primary indicators of this downturn is the alarming rate of youth unemployment. The severity is such that the Chinese government has ceased reporting official data on the matter. The expansion of higher education in 1998, while initially a boon for the country, has led to an oversaturation of the job market with college graduates, creating a stark imbalance between available jobs and the skilled workforce. The consequences of this oversupply of educated individuals are now surfacing, with the unemployment rate for individuals aged 16 to 24 reaching 21%, a figure that has steadily risen since the survey's initiation in 2018. This economic challenge has driven many Chinese youths to unconventional choices, such as participating in lotteries as a perceived pathway to financial freedom. Additionally, a growing number are opting to stay at home, unable to find work, and contributing to a significant portion of the population that may be over 65 by 2050. While the Chinese government disputes these figures, attributing them to survey methodologies that need improvement, the severity of the youth unemployment issue is a clear sign of the economic struggles the country is facing. Moving on to the real estate crisis, it's crucial to understand its profound impact on China's economic landscape. The rapid growth of the real estate sector, fueled by citizens' investments and speculation, has reached unsustainable levels. The market's staggering 70% tie to the country's wealth has left it vulnerable to shocks. The slowdown in economic growth has made it increasingly difficult for property developers to secure the necessary capital, resulting in defaults and protests. The financial instability in major real estate developers, including Evergrande and Country Garden, threatens to exacerbate the economic downturn. In response to the economic challenges, the Chinese government has sought to stimulate growth by lowering interest rates. However, this tactic may be too little, too late, especially given the unique characteristics of the current situation. Deflation has become a pressing concern as consumer spending in China has contracted. The 3 years of lockdown have left consumers reluctant to part with their money, causing prices to fall by 0.3% in July. Companies, in turn, are reducing their workforces, creating a vicious cycle of falling prices and diminishing demand. This deflationary trend is further fueled by the fact that Chinese consumers are spending less due to the slump in housing prices, which has affected their savings tied up in property. Jobs linked to the housing market are disappearing, and the overall uncertainty about the depth of the crisis has instilled fear in companies and small businesses, leading to a cautious approach that stifles spending. Now let's delve into the looming shadow banking crisis and its potential repercussions for China's financial stability. Unlike traditional banks, which operate within strict regulatory frameworks, shadow banks exist in unregulated sectors such as hedge funds, private equity, and investment banks. These institutions offer higher returns, but operate with less oversight, creating an environment that allows for more risk. One of China's largest shadow banks is now under scrutiny after missing payments to 3 publicly traded companies, sparking protests outside its offices in Beijing. This shadow banking crisis introduces a significant element of risk to the already fragile economic situation in China. The nature of shadow banks catering to businesses, funds, and large investors seeking higher returns exposes them to sectors that are particularly vulnerable, such as real estate. Given that a substantial portion of the returns from these shadow banks is tied to the real estate market, the ongoing crisis in the property sector poses a direct threat to their financial stability. The potential for contagion is a real concern. If shadow banks fail to meet their obligations, companies that rely on these funds may experience financial distress, creating a domino effect throughout the broader economy. If companies fail to receive their expected funds, it can lead to a chain reaction of defaults and financial instability. The official statement from the shadow bank in question indicates that they are actively checking their underlying assets and trying to recover assets. However, the lack of transparency and clarity in their statement raises concerns about the extent of the issue and the potential impact on the broader financial system. It's essential to recognize that the shadow banking crisis is not isolated but interconnected with the other economic challenges facing China, including youth unemployment, the real estate crisis, and deflation. The potential for a widespread economic fallout is a real and pressing concern, and addressing the shadow banking crisis requires strategic and decisive actions to prevent further escalation. Now let's explore the potential global impact of the economic challenges and crises unfolding in China. Firstly, it's crucial to recognize that China's status as the world's second-largest economy means that any significant disruptions within its borders can reverberate across the globe. The interconnectedness of the global economy implies that what happens in China does not stay confined within its borders. One area of concern is the potential spillover effect on global financial markets. While it's reassuring that the United States seems to have minimal direct exposure to China's financial crisis, there is always the risk of a psychological impact on global investors. If irrational panic ensues, it could lead to temporary sell-offs and increased market volatility, affecting not only China but also other economies. Secondly, the slowdown in China's economic growth can have a cascading effect on international trade. China plays a significant role in the global supply chain, and a downturn in its economy could lead to reduced demand for raw materials and finished goods from other countries. This, in turn, could impact economies that are heavily dependent on exports to China. Additionally, the deflationary pressures stemming from China's economic challenges might offer a short-term reprieve for other nations dealing with inflation. Weaker foreign demand from China could contribute to a more stable pricing environment in certain regions, particularly for commodities and manufactured goods. However, it's important to note that the potential for a widespread economic fallout from China's crisis might be tempered by the country's relatively limited exposure to the global financial system. Unlike previous global financial crises, where contagion spread rapidly, China's financial system is somewhat insulated due to capital controls and restrictions on foreign investment. In conclusion, China's economic troubles are real, and the ticking time bomb is getting louder. From youth unemployment to a real estate crisis and shadow banking issues, the challenges are mounting. While the global impact may be limited, it serves as a reminder that China has a long way to go to surpass the United States. Thank you for watching, and as always, hit the like button, subscribe, and let me know your thoughts in the comments below. Until next time.